Hello and welcome. My name is Austin if you're new here, and I'm a certified financial planner practitioner. On this channel, we help educate you on complex financial planning topics. If you like this video, give it a thumbs up and subscribe to our channel for more helpful content. All right, let's talk about distribution strategies in retirement. So to preface, what I'm about to share doesn't have a right or a wrong answer to it. These are just different strategies and situations that I've come across and that could relate to what you're going through and could help you think about how to plan out your distributions in retirement. Okay, so I've got a list of various income sources for retirement here. You've got many people have investment accounts. There's other fixed income sources here that you can see. So let's just take an example where somebody needs to have an income of, or they have expenses of $150,000 in retirement. So we start with looking at the fixed income sources, right? So the fixed income sources are going to take up a portion of that, and this is just an example here, right? So your Social Security, you're going to know that that's got a fixed income that's going to last your whole life. Many times pensions do, annuities, other sources of incomes. Right, so this is going to take up a portion of your expenses. But then you're going to look over here to your investment accounts to make up this difference here, right? So first you have inherited IRAs. Now, inherited IRAs are going to have different required minimum distribution rules depending on when you inherited it, okay? Prior to January 1st of 2020, there was different inherited IRA RMD rules, and now after January 1st of 2020, there's a 10-year distribution rule. So I'm not going to get into the specifics of it, but if your inherited IRA that you inherited from your family member or loved one, if it has a required distribution attached to it that you have to satisfy every year, typically it's recommended to pull from that first, right? To fill in this gap of some more expenses that you need to cover, right? So if we look there, we've got their inherited IRA that takes up a portion of your expenses, right? That needs to be satisfied every year, so you might as well be using it to help contribute to expenses that you need to cover rather than pulling this gap of expenses from another account and still needing to satisfy the inherited IRA. Okay, so we still have a little bit more that we need to cover of our expenses. So where do we go next? Well, if you have a traditional IRA and you're over the age of 73 in 2023, that's the required minimum distribution age. And if you're over that age, then you'll need to satisfy your own personal required distribution as well. And that typically comes from traditional IRA or rollover IRA, whichever you have, and that can be used to fill in this gap. If that required distribution is still not helping you meet your expenses or enough to meet all of your expenses, then you might look to your after-tax accounts. This should be individual accounts, joint accounts, trust accounts. These types of accounts, these after-tax accounts, are going to be taxed at a lower tax rate. If you've held them for over a year, you'll get long-term capital gain tax rates on the funds that come out of those accounts versus IRAs are taxed as ordinary income at ordinary income tax rates. So this is more preferred, and you can allow, so let's step back and look at another example, right? So if you've got someone who's still, maybe they're 65, right? And they're nowhere near their required minimum distribution age. So many people will let this account continue to defer the tax and continue to get tax-free or tax-deferred growth on it. And they'll come down here and they'll pull from their after-tax accounts until they're absolutely required to start pulling from their IRAs, right? So, and then many people have Roth IRAs. These accounts are great. Most of the time they're saved for last because you get tax-free growth and income later on when you pull out. As long as you can get some tax-free growth on this account, the better. Right? So many people wait until the end to pull from those. Sometimes they might not need them and they end up passing those along to heirs. So this is not a one-size-fits-all strategy, right? Like I said, there's not a right or wrong rule of thumb here that must be followed. Everybody's situation is different. And so, for example, you may have somebody who has a large portion, maybe 80–90% of their retirement money is tied up in an IRA. If that's you and you have very little in an after-tax account, then even if you're not required, even if you're still 65 or 66 and you're not required to pull from here, you may decide to pull from here instead, right? And because what if you had a large expense that came along in retirement, a healthcare expense or a large expense that came along and you needed money for that? If you had depleted these accounts first and all you have left at age 75 or 80 is your IRA accounts, then all the money you pull from your IRA to cover that expense is going to be taxable in the year that you pull it out at ordinary income tax rates. So you can kind of help control your tax burden and your tax bracket a little bit by having a little bit of diversity in the types of money that you have in these accounts. So that's just one example. Other examples might be, some people have goals where they'd really like to pass as much as they can on to their heirs. So some people may decide that as part of their income that year, they're going to actually convert traditional money into, pre-tax IRA money into after-tax IRA money. It's called a Roth conversion, right? So people may decide to take a distribution from the IRA and convert it into a Roth, pay the tax today so that their heirs can inherit a bunch of money tax-free in the Roth IRA. So everybody has different strategies on how they're going to meet all of these expenses. All right, so we've got, there it is, the last expense. So all of these expenses can be met in different ways, but that's just to give you an idea of a few ways that people usually go about it. Here's just a quick example showing you what this might look like over time, right? So let's pretend you're here at age 65, you've retired, you start Social Security, spouse starts with Social Security around age 70. So that takes up a portion of your expenses. You maybe got a pension, an annuity, and then the orange area being withdrawal from savings and investment accounts like we were talking about. Okay, in this particular example, it's expecting, hey, what if someone were to pass away around age 90, expenses are reduced, certain expenses decrease, certain income sources decrease, expenses are reduced. So this just gives you an idea of what that might look like. It's going to be different for everybody. Again, there's not a right or wrong answer to this, but I encourage you to seek the help of a licensed professional to assist you in this analysis and what makes the most sense for you. All right, thank you for watching. If you have questions about what you've learned, click the link in the description to learn more about our firm and how we can help. Thanks.